AFC Learning, and this is our first session, Empowering Compliance, Maximizing BSA Efficiency with Financial Partners. My name is Colin Darke, and I'm the Senior Advisor to Fintech Training and Education Programming for the American Fintech Council. And through this, I'm focused on the AFC Learning. And we're going to focus on giving banks and fintechs actionable tools to meet their legal and compliance obligations. And for this webinar, we're going to get started right away. And please feel free to ask questions in the comments throughout the presentation. Now, it's my distinct pleasure to welcome one of the foremost experts on BSA AML compliance, Mr. Mark Deaver.
Colin, thanks so much. And good morning, everyone. I appreciate the opportunity to be with you as we kick off this AFC Learning, this inaugural session of AFC Learning, talking about one of my favorite topics, bank secrecy. So we're going to cover a few things in the hour that we're going to be together. I'd like to start just to get everybody on the same page and review some of the important acronyms that we use in bank secrecy. BSA, if you don't know, is acronym HAPPY, okay? Second only to ACH. BSA has got the market cornered on the utilization of acronyms. Now, I lived with the ACH folks for 10 years. We'd go for months without speaking English. We simply spoke ACH. But right behind that comes BSA. So we'll just run through a quick list of acronyms just to be sure we're all on the same page. What's really driving our discussion, and the second goal, I want to talk about the important points coming out of the just released third-party risk management guidance from the federal bank agencies. So your bank partner is looking at this document that was released 2 months ago and figuring out how to comply to keep the regulators on our side of the world happy with us as we partner with fintechs to deliver products and services to our respective customers. We'll talk about the critical responsibilities imposed on your bank partner because BSA is very, very important. We're talking about BSA, we're talking about anti-money laundering, and we're talking about countering the financing of terrorism. And so all that gets wrapped up into that BSA umbrella. We'll talk about OFAC as well. And it's really important from an OFAC standpoint that we understand that not only does your bank partner have OFAC responsibilities, but you as the fintech has OFAC responsibilities, just like you, the human, has OFAC responsibilities as well. And then, of course, as Colin mentioned, any questions that may come up, we'll try and address as we go through. Don't save them up till the end of the program. Go ahead and use the chat function, and we'll talk about that as well. So, some acronyms: AML, anti-money laundering, combined with the CFT acronym, the countering the financing of terrorism. That's really where the focal points are in bank secrecy. BSA is kind of the global term, the term we've used for over 5 decades. And now they're really focused on anti-money laundering and the countering of the financing of terrorism. Bank secrecy started it all 53 years ago. It was called the Bank Secrecy Act, but we've broadened that, we've expanded beyond that. The compliance challenge for your bank partner in the 53rd year of BSA is CDD, customer due diligence. Okay, and when we say customer, remember from the federal agency standpoint, customer means both customers and members. Bank means banks, savings loans, and credit unions. Okay, BSA does not care what your charter is. BSA does not care who you're regulated by. Everybody does the same thing. Okay, and so they just use the term bank because it's easier. Okay. They just use the term customer because it's easier. Okay. Didn't take them more than 2.6 nanoseconds 53 years ago to realize it was a whole lot easier to type B-A-N-K each time than it was B-A-N-K savings and loan, comma, credit union, comma. They love them all. They just call us banks. They love them all. They call them customers. It's not a slight. It's not an insult. It's just ease of typing. Now, the granddaddy of all reports. In the beginning, BSA was simply file reports, keep records. The granddaddy of all reports is the currency transaction report. And though most of you will not encounter cash, if you're in, and we have some fintech clients that are dealing in cash. If we deal in more than $10,000 in cash, by around half of the same person on the same business day, there's a responsibility for filing as well. And so that's the CTR. DFI, of course, another acronym for Depository Financial Institution, which is even shorter than bank. When we talk about the FBAs, the federal banking agencies, those are the 4 regulatory agencies. So it's the Federal Reserve, it's the Federal Deposit Insurance Corporation, it's the Office of the Controller of the Currency, and it's the National Credit Union Administration. So those 4 together make up the federal banking agencies. Now, an acronym you'll see in many of the slides on the screen today is FinCEN. That's the Financial Crimes Enforcement Network. That's the Bureau at Treasury that administers bank secrecy. Worked all the miracles coming out of Title III, out of the Patriot Act after the 9/11 attacks, and is implementing all the requirements out of the legislation passed 2 years ago, the Anti-Money Laundering Act of 2020, better known as AMLA. So FinCEN is basically who on the bank side that we're working for when we're doing bank secrecy. MSBs, that acronym, Money Services Businesses. Some of you may actually be money services businesses, and I'll talk about that in just a second. OFAC, the Office of Foreign Asset Control, a different group of Treasury. This is the group that administers the economic sanctions enacted against hostile targets, people, places, things that by law we can't do any business with. And all of us have OFAC responsibilities and OFAC implications. And then the most important piece of BSA today is the suspicious activity report. We file the SAR when we know or think we know that a federal crime has been intended or committed, or the transaction is not consistent with what we've been expected, and we don't have any reasonable explanations for that. And SAR is really rare. Even though millions, literally millions of CTRs are filed every year, the focus of BSA today is on the SAR. Now, speaking of MSBs, money services business is an entity that deals in foreign exchange, cashes checks, issues or sells traveler section money orders. And for those three, they do so in excess of the limit in the regulation, which is $1,000 per person per day. So long as you do not cash your checks in excess of $1,000 per person per day, you're not an MSB. But if you were to cash check or checks in excess of $1,000 per person per day, you're a money services business and you have BSA responsibilities. But the one that may catch some fintechs is if you are a transmitter of funds. Anyone who would transfer any amount of money for anyone else over a third-party funds transfer network is a money services business. And just added 4 years ago, an administrator or an exchanger of virtual currency is also considered a money transmitter under the MSB rules, and the BSA policy must be in. Now, you may have Bitcoin loaded to your phone or your thumb drive. You are a user of virtual currency. You are not an MSB. The guy you bought it from, he is. And he is considered to be a money services business. And then folks who are selling gift cards, prepaid access is what the term the reg uses, in excess of the dollar limits are also considered money services businesses. So as a fintech, if you're involved in any of those, you personally have BSA responsibilities under the BSA regulations. What really drove the whole discussion and the reason for this kickoff session was, of course, the publication in June of the third-party relationship risk management, okay, or the TPRM, third-party risk management guidance. The agencies got together. They've been working on this for well over a year, and they published the final guidance that your bank partners will be following as they go through. 3 of the 4 agencies picked up on that, and these are the documents that it was attached to. For the FDIC, it's called a financial institution letter. For the Federal Reserve, it's called a supervision and regulation letter. The OCC calls it just a bulletin, and that's where your bank partners found that. But the guidance offers the agency's views on sound risk management principles for your bank partner to consider when developing and implementing risk management practices for all stages in the life cycle of the third-party relationship. And they talk about this life cycle, but we'll cover in just a second. Concepts discussed are relevant for all third-party relationships and are provided to organizations to assist in tailoring and implementing risk management practices commensurate with your bank partner size, complexity, risk profile, and nature of its third-party relationships. Now, very important is that last sentence. The agencies plan to develop additional resources to assist the smaller banks, the smaller non-complex community banking organizations managing relevant third-party risks. And many of you are partnering with the small community banks, and they're wonderful people. They're our bread and butter as well. And so we're expecting additional guidance for those folks. The guidance, of course, is intended to assist the organization in identifying and managing risks. The principles set forth can support effective third-party risk management for all types, regardless of how they may be structured. Some organizations may form third-party relationships with new or novel structures and features, such as with fintechs. Such relationships may involve the fintech company providing products or services with varying degrees of interaction with the bank partner's customers. It's important for the organization to understand how the arrangement is structured so that the organization may assess the types and level of risk posed and determine how to manage the relationship effectively. So the press release came out on June the 6th. It hit the Federal Register on June the 9th. The Federal Register people got together and got that out pretty quick. Sometimes it takes a while to get those things published in the Federal Register, but they did a pretty good job this time. It only took them 3 days. Just some salient points contained within, and it's a multiple page document. It's 18 pages of Federal Register print, so it could take you a few days to get through the whole thing. But just some salient points I want to share with you. The guidance states that as part of a sound risk management, the organization analyzes the risk associated with each third-party relationship and adjusts its risk management practices commensurate with your bank partner size, complexity, risk profile, and nature of the relationship. That's really the key. That's what your bank partner is going to be trying to do. Talking about the life cycle of the risk management, okay? They use the triangle with the circle in between. 5 stages in the life cycle in the middle: planning, due diligence, contract negotiation. Very important that contract is there to protect everyone and to make sure everyone understands who's on first, as they say. Ongoing monitoring, and then of course the termination provision as well. Surrounded on the triangle with 3 governance practices: oversight and accountability, independent reviews, and documentation and reporting. Now, it's really, really important that you understand that from the bank's standpoint, the federal banking agencies are going to review your bank partner and review your bank partner's risk management of the third-party relationships as part of its overall supervisory process. Supervisory reviews will evaluate risks and the effectiveness of risk management to determine whether the activities are conducted in a safe and sound. Safety and soundness, that's the magic word within the bank world: safety and soundness, and in compliance with the laws and regs. A couple of other points: when circumstances warrant, an agency may use its legal authority to examine functions or operations that the third party performs on the banking organization's behalf. So your bank partner may come to you and say, hey, you and I are getting audited by the FBAs. Such examiner may evaluate the third party's ability to fulfill its obligations in a safe and sound manner and comply with the laws and regs, including those designed to protect customers and to provide fair access to financial services. The agencies may pursue corrective measures, including enforcement actions when necessary, to address violations of law and regulations or unsafe and unsound banking practices by the organization or its third party. And your bank partner knows that even though they're using a third party, they are still accountable. They are still responsible. They can outsource the function. They cannot outsource the accountability. They cannot outsource the responsibility. That all falls on them. And the guidance just goes and reminds us of that. The use of third parties does not just diminish or remove the organization's responsibilities to ensure that activities are performed in a safe and sound manner and in compliance with the laws and regs, including but not limited to those that are designed to protect consumers, such as fair lending and prohibitions against unfair, deceptive, or abusive, and those addressing financial crimes, which is the addressing financial crimes is our segue into the BSA piece. BSA began 53 years ago. Congress, in its infinite wisdom, passed the Financial Recordkeeping and Currency and Foreign Transaction Reporting Act. And that was such a mouthful, we shortened it. We called it BSA. And 53 years ago, BSA meant 2 things. Anytime a client had more than $10,000 in cash, we filed a CTR, and 2, we kept some records. That's all we had to do 53 years ago. File reports, keep records. Life was good. That goodness lasted the next decade, but that second bullet on your slide, 1986, Congress passed the Money Laundering Control Act, which for the first time made money laundering a crime. Hadn't been criminal activity before. No, all we had to do was report and record. Now, they made us deal with criminals. More importantly, this was the statute that formally and officially made your bank partner establish a formal BSA policy. Assuming the bank's been open for the last 37 years, or if it hasn't been, the day they opened the door, they had to have a BSA policy in place that included the 5 tenets or 5 pillars. Their board is designated an individual or individuals responsible for coordinating, monitoring day-to-day compliance. Often that's referred to as the BSA officer with a deputy or an assistant BSA officer. They've implemented a system of internal controls to assure ongoing compliance. They do independent testing every year. Now, those 2 words, the key word is independent. Not that they audit every year, but somebody outside of the day-to-day activities of BSA must do the test. They have an internal audit group themselves. They can do it internally. If not, they have to come and hire someone like FORVIS or someone else to do the test. Key is not that they audit. Key is that it's an independent test. And then the 4th pillar why we're all here is that by law, everybody must be trained every year on BSA. You know, I'm not stupid enough to believe you're here because you love me. No, you're here because the law requires us to be trained. We just appreciate the fact that you picked FORVIS to be your training provider. And then just added 5.5 years ago was the whole CDD piece, the customer due diligence piece. Okay, the customer due diligence piece. Customer due diligence, where we understand the nature and purpose of the customer relationship for the purpose of developing this customer risk profile. And we conduct ongoing monitoring to identify and report suspicious transactions. And on a risk basis, maintain and update customer information. Customer and member information includes beneficial ownership. That's the focus today. The focus today is CDD. Now, just as a quick sidebar though, if you are one of those money services businesses that we talked about a few minutes ago, you have to have a BSA policy that covers those as well. Okay, so that applies to anyone who has BSA responsibilities. The formal policy needs to have those 5 pieces to it as well. So CDD, customer due diligence, okay? And requiring us to perform effective CDD, and that lets us understand who our customers are and what transactions they conduct. In FinCEN's mind, CDD, 2 things. We know who they are, and we know what transactions they conduct. Because that's a critical aspect of combating all forms of illicit financial activity. Okay, that's really the concept. 4 elements in CDD. 1, identifying and verifying the identity of customers. We call that today CIP. CIP impacts you as a fintech if you are opening or participating in the account opening process with your bank partner, because we have to comply with the CIP. We'll talk about the elements of CIP in just a second. Second element of CDD, we have to identify and verify the identity of beneficial owners of legal entity customers, the humans who own or control those legal entities. So if you're opening business accounts with your bank partner, the beneficial ownership information needs to be collected. Okay. Now, whether you're going to participate or how much you participate in that, that's what is negotiated as the relationship is built. Third, understand the nature and purpose of the relationship for the purpose of developing this customer risk profile. It had been implied for 20 years. Okay. Now it's explicitly required. Because to be able to do SAR properly, we have to profile. Because the law of SAR says we have to file a SAR when the transaction is not normal. How do you know when the transaction is not normal? Well, you got to know what it is. You cannot comply with the law of SAR, which is the law, if it profile. And then 4, conduct ongoing monitoring to identify and report suspicious transactions and on a risk basis, maintain and update customer information. SAR just celebrated its 27th birthday back in April of this year. The SAR was born on April the 1st. 1996. SAR was born on April Fool's Day. Think about it. But collectively, those 4 elements comprise the minimum standards of CDD, which FinCEN believes are fundamental to an effective AML BSA program. From a CIP standpoint, when Congress passed the Patriot Act, 2 months after 9/11, Congress said, look, financial institutions, anytime you open a new account, you must do 3 things. You got to verify the identity of anyone seeking to open an account with you. You got to maintain records that have been used to verify their identity. You got to determine whether or not that person appears on any federal government provided list. How do we do that? We do that with our CIP program. The whole goal of CIP is to enable us to form a reasonable belief that we know the true identity of the client. Is the person standing in front of me? Probably you're not going to see that very often from the fintech standpoint, but on the bank side, your bank partner side, they have branches, they have a branch network. People are walking in the door to open accounts. But is the person standing in front of me? Is the person on that website? Is the person on the phone who they said they were? The answer is yes, CIP worked. If the answer is no, then either CIP failed or they're not who they said they were. Operationally, we do 5 things to comply with CIP. 1, your bank partner made a ton of decisions 20 years ago. What information are they going to obtain before they open a new account? And they obtain it before they open the account. And again, if you're opening accounts with your bank partner, they will tell you what it is that they want to, what information they want from that account output. Second step, we verify the identifying information that we got in step 1. 2 types, documentary and non-documentary. Again, opening accounts online. Documentary is pretty challenging, but we use non-documentary to do that. Third, federal law requires us to give a notice that says federal law makes us do this. And in the final rule, there was language included that most of your bank partners used in the notice. Fourth, we got to compare and match the names of all new account applicants against federally provided list of terrorists. And our friends at OFAC are the only ones currently that have a federally provided list of terrorists. And then, of course, fifth, we got to maintain a record of all the information we obtain. So 5 things. 1, your bank partner has figured out what they're going to get and get it before they open the account. 2, within a reasonable period of time after the opening account, they verify what they got in step 1. 3, we give them a notice that says we got to do it. 4, we compare them to a list of terrorists. And 5, we keep a record. That's CIP. And we've been doing it for 20 years. Hopefully, anybody coming in to any financial institution or working through a fintech to open understands that, because if they've tried to open an account anywhere, this is no surprise. We've literally been doing this for 2 decades. It celebrates its 20th birthday later this fall. But from an ongoing standpoint, from a CIP standpoint, what's the ongoing biggest issue? The biggest ongoing issue and challenge with SIP, and of course that's private, and we call CIP, we call it SIP. Some credit unions, they still call it MIP. Call it MIP, you can call it SIP, you can call it whatever you want. Doesn't matter. You gotta do it. But the biggest ongoing issue is privacy. Privacy. Federal law now requires us to collect and retain for 5 years after the account is closed everything an identity thief needs to steal the customer's identity, with name, date of birth, physical address, and 10 IMU. So how are we safeguarding that? How are we protecting that? How are we securing that? In the banks, when we're talking with banks, does the CSR leave it on our desk when she goes to lunch? Oh, I hope not. Do they keep it in a locked file overnight? Gosh, I hope not. Okay. Now, if you're exchanging identification information, are we doing it over encrypted lines? Are we securing it? Okay. So if they can get that CIP information, they can steal the identity of the clients, of the bank partner's clients. From the beneficial ownership standpoint, when we talk about beneficial ownership, we talk, if they can steal the beneficial ownership information, they can steal the identity of the owners of the bank partner's best customers. Okay. And of course, working online, you know the old adage, of course, on the internet, they don't know your dog. All right. But there was guidance from the FFIEC agencies 2 years ago, where they updated some really, really, really old guidance. Guidance had been issued in 2003, and 2005 initially, and then slightly updated in 2011. But they've really issued some additional guidance with regards to the technology. And in a nutshell, basically, it says single factor authentication just ain't going to get it anymore. Okay, you need multi-factor with layered security. And I know on the consumer side, they don't want all these barriers. They just want it as free as possible. Gang, it's 2023, and when you look at the Federal Trade Commission and the fraud reports and all the fraud that's out there, it can't be. Okay, it needs to be safe and secure. So that's the CIP piece. On the beneficial ownership piece, the key elements of beneficial owner, we identify the beneficial owners, the humans who own or control legal entities, the businesses that are opening the account with us. Today, and that's an interesting point because AmLaw may modify this, but today, August the 10th, we have 2 prongs. We call them prongs. The ownership prong, we identify anyone who owns 25% or more. The control prong, we identify the one person who has significant authority to control, manage, or direct. Okay, those may change. They may be expanded. We just don't know at this point. Once we've identified them, we verify them using the same tools that we use with CIP. We record all the information, okay, and we utilize it to do OFAC, to do negative media searches, and to do some CTR. But we've been doing beneficial ownership for 5.5 years, and most of your bank partners at this point, and I ask this question in every class. I say, okay, 5.5 years into this, do you have about 50% of your business clients where you have the beneficial ownership? And everybody's pretty comfortable with that. 2/3 may be a stretch, but they feel pretty good on that at that 50% mark. So, got CIP, the first element, beneficial ownership, the second element. The third element, of course, is establishing that customer risk profile, so we understand the nature and the purpose. We understand what's more. And again, this is not new. To comply with SAR, we've been profiling for 27 years. This third element had always been implied. Folks at FinCEN don't like implication. They like explicit. So they pulled it out and they made it the third element. But your bank partner's been doing it, and they're going to look to you to help them establish that profile, establish that baseline. What is normal for this customer, so that they can do the SAR monitoring and the SAR reporting, which of course is the fourth element, the most important element of CDD. And that, of course, is we have to do ongoing monitoring to identify, and more importantly, report suspicious transactions. Okay. In fact, FinCEN, as part of that element, indicated that the minimum standards of CDD include ongoing monitoring of all transactions going by at or through. Now, don't panic. Guarantee you they're not monitoring every single transaction, because FinCEN then came along and said, now look, we're going to clarify that this does not mean you have to monitor every single transaction. Nobody's doing that. No, your bank partner is going to apply a risk-based approach and determine the level of monitoring to which each account will be subjected. And FinCEN expects the level of monitoring to vary across accounts based on the institution's assessment of risk associated with the client and the account. The key is consistency. And the key is your examiner happy with what you're doing? Okay. So that then begs the question. We have to identify and report suspicious transactions. So how do we do that? In identifying suspicious transactions, you've reached the fork in the road and need to ask and answer 2 questions. Question 1, is the transaction in question a crime? Yes? No. The answer is yes, turn left, file the SAR. Gang, we report crimes. It's really simple. We report crimes. If it's criminal activity and hits the dollar amount, your bank partner files the SAR. It's that simple. We don't even have to think about it. If it's a crime, boom, we file the SAR. No, but if the answer to question 1 is no, it's not a crime, we turn right. We ask and answer question 2. Is it then suspicious? What makes a legal transaction suspicious? What makes a legal transaction suspicious? It's inconsistent. It's inconsistent what we had profiled to be the normal activity for that client, and we have no reasonable explanation for why. That's the key. So there are 3 legal definitions in the suspiciously reportable transaction. 1, it's a crime. 2, the transaction is designed to evade any of the reporting requirements under BSA. Call that structuring. On the cash side, that's called structuring. Customer walks in the branch with, given the fact that the CTR limits more than $10,000, they come in with $9,998. They are structuring that cash transaction to avoid the reporting. That's a crime. SAR would be filed. But key is the inconsistency. And that's what we call the SAR test. The transaction we're reporting has no business or apparent lawful purpose, or is not the sort of which that particular customer would normally be expected to engage in. And how do we know the first half of that? Because we've done our CDD. We know what's normal. We know what's normal for our client. And we know this is not. And keep reading. And we don't know why. We have no reasonable explanation. And we've looked. We've examined the available facts, including the background and possible purpose. That slide is CDD. We know our customer. We know what's normal. We know this is not. We don't know why. We're saying law enforcement, yo, this could be suspicious. If you'd like to look at it, fine. And if you don't, I don't care. I got a lot more SARs to file. Your bank partner does not get hung up on what law enforcement does or doesn't do with the SARs. See it, report it. FinCEN's own words. Okay. Now, we file a lot of SARs. Well, the nation as a whole files a lot of SARs. Okay. Your bank partner is one of 7 groups that are filing SARs. But last year, 4.3 million SARs were filed. Okay. 1 year, 4.3 million SARs. Over 20 million CTRs, cash in excess of $10,000, filed on behalf of the same person on the same business day. The CMR, 128,000. The FBAR, 1.5 million. And the 8,300, it's another type of CTR that someone like Churchill Downs or a car dealer, if they were to take in more than $10,000 in cash, they would file that as well. But you see all the various groups. Your bank partners would be logged under depository institutions, but MSBs filed 1.3, almost 1.4 million SARs as well. Casinos are filing SARs, securities brokers and dealers, loan finance companies, insurance companies, and that. So they've spread the wealth. It's not just banks that are filing SARs.
Hey, Mark.
Yeah, Colin.
With the SARs, is there a template that bank partners are supposed to follow, or is there standard terms that would help like the federal government parse through all this data that they're getting about suspicious activity?
Within the SAR report itself, there is a section where they have statistically, well, you see the activity types. There's actually checkboxes where you can, if it's like box 38, D is elder financial exploitation. 38G is human smuggling. 38H is human trafficking. And there's various categories. There's money laundering. There's other activities. There's pure fraud, loan fraud, check fraud, all those. And so there are statistically tracked sections, but we can write in all sorts of things because every one of those categories has a default box where we can write things in. But FinCEN, in all of their issuances, when they want us to focus on something specifically, they tell us exactly what to put in the SAR, the keywords that they will then use to search through the database looking for that. FinCEN will use it, law enforcement will use that as well. Now, how the fintech will refer suspicious transactions to their bank partner, the bank partner may have an internal referral form set up, and that's going to vary bank to bank as to just what information the bank and how the bank would like you to categorize that as well. What happens with that data? Well, 472 federal, state, and local law enforcement, regulatory, and national security agencies have access to all these reports. And 25,000, and there's 25,000 personnel within those just shy of 500 users. And last year, they came into the data 2.3 million times looking through that. We did file a ton of SARs, and we're continuing to file a ton of SARs. There's over 35 million SARs in the pile, okay, over the last 27 years. But this is just the first quarter snapshot. For us, banks, savings loans, and credit unions, we filed over 500,000 SARs. 90 days, 500,000 SARs. All 7 groups filing SARs, of which your bank partner is just one of 7. 938,000 SARs, just a little less than 1 million. Now, those are impressive, but look at that percentage increase. For the bank side, that's a 17% increase over the first quarter of 22. And for all 7 as a total, that's a 5% increase over it. So the numbers continue to rise. Now, the rest of this data is just your bank partner only. And your bank partners are really, really, really concerned. Last year as a whole, and it's continuing this year, check fraud was the #1 most often reported. Over 10% of the SARs referenced check fraud. Okay. I had seen where some specific states where check fraud had been #1. Okay. But last year was the first time the nation as a whole where check fraud was #1. Okay. And it looks like it's going to stay that way. What's usually #1 is #2. That's the structuring, where the customer specifically makes the cash transaction to avoid the CTR reporting. What's usually #2 is #3, suspicious source of funds. Okay. But look at the suspicious credit and debit card fraud. That's over 5.5%. Identity theft, over 5%. Counterfeit instruments, almost 5%. ACH fraud. It's an ACH professional. That one's really upsetting, to say the least. In 2021, ACH fraud was more than 4%. Last year, we got it almost just below 3.5%, but now it's back up again. Okay. And that's a little disconcerting as an ACH professional. And the wire fraud is up. Normally, wire fraud runs at about 1.5% of the SARs filed, but it's up. And of course, we're abusing the old people. Okay. Normally, Elder Financial is about 1% of SARs filed, and it's up to 1.5%. Okay. Now, there's a lot of cyber activity going on. Okay, a lot of cyber crime. When we see it start out with the word against, that's where the cyber event occurred against our client. And now it's almost 5,000 SARs just in the first quarter, where the cyber event occurred against our client. Against the institution itself, over 1,700 SARs were filed in the first quarter. And then other cyber events, ransomware, things like that, it's over 1,200 SARs. And that's just one quarter. That's just 1/4 of the year. Human trafficking is underway. We filed a little over 900 SARs just in the first quarter for human trafficking. Smuggling, not so much, only 65 SARs. Now, it's interesting when you look at the MSB numbers. The MSBs file far more SARs for smuggling than they do trafficking. On the bank side, we file far more SARs for trafficking than we do smuggling. It is what it is. It's just an interesting reversal of roles there as well. And the Ponzi schemes. I talked about this a little bit. You know, after Bernie went to prison for 180 years, you thought people would stop trying to do Ponzi schemes, but yet we still filed between the two, pyramid and Ponzi. I mean, that's almost 150 SARs in that. Now, there's 50 states in our country. The state that files the most SARs, at least in the first quarter, surprisingly enough, was North Carolina. For years, it was California. It always went California, New York, Florida, Texas. Well, it's shifted. And now little old North Carolina is the top SAR filing state. California dropped to second, and that's not by 1 or 2, that's 4,000 SARs. Ohio moved up to the 3rd spot. Virginia's 4th, and you got to get down to number 5 before you get to New York. Texas, Florida, Delaware, Illinois, and Georgia round out the top 10. Now, not only do they allow us to sort by state, but they allow us to sort by city. Traditionally, California was number 1 state-wise. New York City was number 1 city-wise. But New York's been supplanted, and now it's little old Charlotte. I don't know what's going on, but what's happening in North Carolina is happening in Charlotte. I don't think I'd go there personally, but that's okay. It's neither here nor there. And that's not 1 or 2, that's 22,000 SARs. I mean, that's big time. New York is 2nd, nation's capital is 3rd, capital of Ohio is 4th, Los Angeles is 5th, City by the Bay is 6th, South Florida is 7th, Philadelphia is 8th, Chicagoland's 9th, and Atlanta rounds out the top 10 from that standpoint. They track over 1,000, and you can just run through the list. Honolulu comes in at 48th, okay, at 48th as well. But SAR, that's it. That's where the rubber meets the road in BSA. Yeah, we file CTR, we file millions of CTRs, we keep a lot of records, but SAR is where the action is. And your bank partner is going to rely on you to help identify and refer suspicious transactions so that they can make that SAR filing and final decision. Unless, as a fintech, you are a money services business. If you're a money transmitter, you're doing the money not through your bank partner, but you're doing the money transmission yourself, or you're an exchanger of virtual currency. Then you have the SAR filing responsibilities yourself as well. Let me pause and see if any of the attendees have a question on the SAR piece, because that is the most important part of BSA. Just use your either chat or use your Q&A bar if you've got a specific question on SAR and SAR filing. Your bank partner is going to tell you, or more than likely, refer or have some type of mechanism where you would refer what could be a potentially suspicious transactions to them. It'd be an internal document that they've developed themselves. Sometimes it's called a SIR, a suspicious incident report. You call it whatever you want, but there will be some mechanism that you will refer suspicious transactions to them so that they can make that SAR file decision as well.
So in advising fintechs, would you advise them, err on the side of reporting and then leave it up to the bank to whittle it down?
Yes. It's just like when internally with the bank partner, internally what they've told all their team members, they don't want the folks out in the branch making a decision whether something's suspicious. They don't want the folks down in operations making a decision whether something's suspicious. They say, refer it, we'll make the decision. Okay. And that's all that. And that's what fintech needs to do. If it all could possibly be, go ahead and forward it over. The bank partner has the compliance team that will take it and run with it because they have that whole SAR filing mechanism set up in place. Under the SAR rules, there is a safe harbor. So as long as if we're filing, if we're not sure, as long as we file in good faith, okay, that's the key. Now we can't be, oh, I don't like this guy, let's just file a SAR. No, we can't do that. No, but as long as we're operating in good faith, we're okay for that. I do want to talk about a couple of other things within the BSA world. SAR is the most important, but I do want to talk about a couple of things where the fintech may have to help us, and that's under what they call the Section 314A process. Again, this is coming out of the Patriot Act from 20 years ago. But what happens every other Tuesday is that FinCEN will provide a list. Okay, law enforcement has gone to FinCEN and said, hey, will you ask the banks if they have accounts for these people? Okay, we're investigating these people. They make the case to Treasury that it's worth asking the banks to search through their databases to see if we have accounts for these folks or we've done transactions outside of an account for these folks. And normally this list comes every other Tuesday. There are special requests that can come anytime, but normally it's every other Tuesday in that. Well, your bank partner may need your assistance depending upon who's keeping the account records. Okay, if you're keeping the account, if the fintech's keeping the accounts the individual accounts on their books, where the bank partner just has one big general account rolling everything up, and then they may need to look to the fintech to do that 314A search for them as well. Yesterday, for example, the list had 218 names on it. Okay. Yesterday was 314A Tuesday, or I'm sorry, 2 days ago was 314A Tuesday, and it was a pretty good sized list on the 8th. There were 218 names on that list. The record list this year, we were close to it. It was 292 names back on February the 7th. Last year, the record list was a huge list. There were 340 names on this list, and you can see that. But what's happened is law enforcement makes the case to FinCEN that it's worth having the banks take all this time to go through these. 13% of the cases are terrorist related, 87% are just pure vanilla money laundering and that. And your bank partners have now searched for a little over 59,000 subjects of interest over time. Okay, and that. And last year, your bank partners reported back 38,000, almost 38,000 positive matches to them as well. So again, your bank partner may ask you to help them with that. One other piece of BSA I'd like to bring up those if you're in the funds transfer business or providing funds transfer services. Remember, under the funds transfer record keeping requirements of BSA, and these date way back. This way before 9/11. Okay, if you're transmitting funds, okay, there's information we have to obtain and retain, keep it for 5 years. If we were to do a funds transfer, if your bank partner was doing a funds transfer for a non-customer, there are special identification processes they have to go through. And then there's what's called the travel rule. There's information we have to obtain and insert into the text of the payment instruction so that it flows with the credit, or it travels with the credit. That's why they call it the travel rule. So information they have to obtain: name and address of the originator, the amount, the execution date, any payment instructions, the beneficiary's bank. I mean, you can't do a funds transfer without knowing where it's got to go. And then the name and address of the beneficiary, the account number of the beneficiary, and any other specific identifiers. Now it says as many of the following is received with the order. Well, without the name and address, the receiving bank can't post it properly. And it really helps to have the right account number along with that as well. So that's the information we have to obtain and retain. And that's the information we have to insert under the travel rule. The name and account number of the transmitter, the address, the identity of the institution, the amount, the execution date, where it's going, and then again, the name and address of the recipient, if they have it, the account number, and any of the specific identifiers. So your bank partner, if you are originating wires through them or originating funds transfers through them, they're going to be asking you to provide this information, okay? Because that has to be in the text of the payment instruction. That's why they call it the travel rule. Now, when we keep all these records under BSA, what do we have to do with them? Well, we keep records to, among other things, comply with the requirements of the Act, utilize the records to develop that risk profile that we have to do, and help us develop the risk ratings for our clients under CDD. But most importantly, search for and report suspicious transactions. Your bank partner knows it's no longer good enough just to have the data. Okay, they expect to do something with that data, including looking for suspicious anomalies, possibly leading to the filing of the SAR. Now, let's shift gears because we all have OFAC responsibilities. OFAC is the Office of Foreign Asset Control. It's the agency within Treasury that administers the Economic Sanctions Act against hostile targets, people, places, things that by law we can't do any business with. Some of the laws enforced by OFAC include, among others, TWIA, trading with the enemy. This is treason. They hang people for less. They enforce IEPA, the International Emergency Economic Powers Act. Many of the detainees held are being held under IEPA auspices. They administer the Foreign Narcotics Kingpin Designation Act. Trust me, you never want to be designated a narcotics kingpin. That's not a good thing. And they administer my all-time favorite, the Anti-Terrorism and Effective Death Penalty Act of 1996. Gang, I don't know anything more effective than the death penalty. Once you're gone, you're gone. Now, OFAC simply, when people say, well, what does OFAC cover? Well, OFAC simply describes the entire known universe. It's covered under jurisdiction. That's what I call the OFAC effect. The entire known universe is covered under jurisdiction. Every citizen, every corporation, every permanent resident alien, every human, and every business located in or organized under our laws are subject to OFAC requirements. I personally do not care of what nation you are a citizen from. I'm making the assumption, though, right now that at this instant, you are sitting in the United States of America, you too personally are subject to OFAC. Okay, we all have, as individuals, we all have personal skin in the OFAC game. Now, thankfully, they don't examine you and I very carefully for OFAC, but as a financial institution, your bank partner gets scrutinized. It gets scrutinized closely in all the various things that your bank partner is doing. Congress does take compliance with OFAC seriously, and the fines are substantial. Banks, savings loans, credit unions, businesses, and humans found liable for violating these laws can be subject to criminal fines ranging up to $10 million, prison up to 30 years, and civil penalties can range from 1/2 the transaction's value up to the statutory maximum as well. OFAC has been busy this year. Okay, they actually took the first 2 months off. Well, they didn't take the first 2 months off, but they didn't do anything enforcement action-wise until March the 1st. But since then, they've collected over $500 million in fines. Okay, now, before you're overly impressed and shocked, the big one, of course, is British American Tobacco. BAT decided they wanted to sell cigarettes to North Korea. Okay, that's what British American Tobacco does. They sell cigarettes, and they said, "Oh, there's a market. The North Koreans love cigarettes. They love our cigarettes, and we're going to sell them." Well, wait a minute. They're an OFAC sanctioned country. We don't care. We're going to sell those to North Korea. If you remember that great old movie, The First Smoking Event, there were a whole bunch of smoking events, but the first one was a classic, right? Jackie Gleason, Burt Reynolds, Sally Field. Some great one-liners came out of that. Well, one of the one-liners that came out of that applies right here. What we have here is a total disrespect for the law. I mean, you can hear Jackie just saying that. What we have here is a total disrespect for the law. And you know what that cost them? It cost them $508 million. Okay. But your bank partners have responsibilities under the fact. We have to make sure that if we're maintaining an account, that we're freezing those assets, or if, depending upon the OFAC sanction, it requires a rejecting or a refusal to do a transaction, we have to know what's going on. Well, this came out last year. This was a finding of violation, which is a little different. That's why it got my attention. It's a finding of violation. It wasn't a specific dollar penalty, but this bank had outsourced the OFAC screening to the third-party vendor. They assumed, you know what happens when you assume? They assumed the vendor was screening nightly. The vendor was only screening once a month. So potentially they were exposed for 30 days. This one, what caught them here, they got caught for 14 days. Okay. What happened is 2 individuals were designated at 12:36 p.m. Eastern Daylight Time. Okay. They probably have it down to the second on September 21st, 2020. In the next 6 hours, they processed 5 transactions for $604,000 for those 2 individuals. Now, the OFAC expectation is not that you will stop all processing as soon as the list changes and scan the files. No, but you can't wait 30 days. Now, what happened is between the next 14 days, 29 transactions totaling just less than $10,000 were processed. So OFAC had two decisions. They could have fined them a little less than $5,000 and nobody would have looked at it, or they could have done a finding of violation, and somebody like me would have said, "Oh, what is this? This is a teaching moment," and that's what they did. So, what we always say to the banks, and for yourself, if you're maintaining accounts, you want to be sure that you know what your policy is, what your process is, what your procedures are in terms of how often are you going to scan as the list changes. Okay, and the list just changed this morning before we actually started this program. But what is it that you made the decision to do, and then is it happening? See, they thought it was happening. They had made the decision to do it every night, but it wasn't. Learn from that teaching moment. Okay, but OFAC applies to everybody, and it's really important that every one of us has what's called a sanctions compliance program, an SCP, sanctions compliance program, to be able to handle your policies and procedures for sanctions compliance and sanctions compliance management. In that, it's really important that you have a document that has sanctions compliance program at the top and words on it. Okay, because if there's an issue, OFAC's going to look. Do you have an SCP? Okay, if you do, that will minimize the impact. Okay, that will minimize the impact of the fine or penalty going forward as well. There's various reporting required under OFAC. Okay, whether you block, meaning you take the money, or reject. Okay, there's various reportings that have to be done. Your bank partner can explain what they would need from you if you're maintaining those accounts, or if you have accounts for yourself, then you've got that piece as well. But OFAC applies to everybody from that standpoint as well. So, just some background on BSA and OFAC and AML, right? How about implications for the fintech and the bank partner? So important. It's so important that you understand what your bank partner wants and needs to be comfortable with a relationship. And of course, you need to be comfortable as well. What do you need from your bank partner in order to make it all work? Bank partner is going to perform due diligence based on the TPRM. They're going to perform due diligence on you and your activities to reach that level of comfort to assure yourself that you have the capacity to perform what it is. So expect them to be asking questions. Again, just as a reminder, the bank partner understands that they can outsource the function, but not the responsibility, not the accountability. Because the banking agencies are not looking at you. They're looking at your bank partner if there is a problem. Contract, and there will be a contract, should clearly identify roles and responsibilities. Who's going to do it? What are they going to do? How are they going to do it concerning CIP? Okay. How are we going to get all that information? We're going to verify that information. Who's going to do that? Who's going to store that? Who's going to protect and safeguard all that? You need to make that decision on the front end, have that in the agreement. 314A, if it applies, who's going to do the searches, the schedule and the specials, who's going to report, who's going to record all those efforts. Again, it's just a matter of making decisions and then including it in the agreement. If you're opening business relationships for your bank partner, obtaining the beneficial ownership information, recognizing that today 2 prongs may go to 3, but it's just whatever will be required at that time. But who's going to do that? Who's going to be responsible for that? And how's all that data going to be retained as well? On the funds transfer record keeping, again, that is the function that you are performing for your bank partner or helping your bank partner with. Who's going to get the travel rule information? Who's going to insert it? How are we going to record it and store it? The whole OFAC piece, okay, really important that the screening is done. Is your bank partner doing it? Fintech going to do it. And then if you're in the cash business, and I don't think a lot of fintechs are in the cash business, but if you're in the cash business, okay, the whole CTR piece and how all those get filed as well. It's interesting. We've been fortunate to have in some of our programs we've done this summer, we've had a panel of federal examiners, and we always talk about, okay, what are you seeing from not a failure, but from an examination or a violation standpoint of that. CTR has been around 53. You would have thought 5 decades into the processing, we could have got it figured out, and yet they are still finding issues with currency transaction reporting. So just want to be sure that if it applies, that that everybody understands whose role and who's doing what, and so that we can do that. It's just 53 years later, you go, okay, why are we still making mistakes on this simple things? Some other implications, red flags, okay, from a SAR monitoring and reporting standpoint, okay. Colin, in terms of what FinCEN has said, here's what you put in the SAR if this is happening. With each of those guidance documents, each of those advisories or alerts or bulletins, it depends on what they call it, but it'd be an issuance talking about this specific topic. Many of them have red flags, a whole listing of things. Okay, look for these. These could indicate that human trafficking is underway, or this could indicate that human smuggling is underway, or these items could indicate that elder financial exploitation is underway. Well, you need to understand the red flags. You need to understand who's looking for the red flags, who's going to refer those. You need to understand that decision flow. Okay, and then regarding filing a SAR on a specific client. Okay, who's going to make the decision as to whether or not to continue the relationship? Now, there's nothing in the regs that says we have to, if we file a SAR on a customer, we have to kick them out. But we're going to think about it. Okay, it depends on what it is we're filing on. but who's going to make those decisions? And then if law enforcement does follow, you need to be aware of the fact that your bank partner may ask you for additional information in that. Again, if the fintech is an actual money services business that's SAR filing, that responsibility is theirs. They're not passing that off to anybody. They're doing it themselves. Remember, from a SAR standpoint, you need to know all hands need to understand there is a SAR. Who does it? How do we refer? What should we do? What questions can I answer? Thanks, secrecy. Those of you out in internet land, any questions? Use your chat pane, use your Q&A pane.
No, I think that does it. Well, on behalf of AFC, I want to thank you, Mark, for this insightful and very informative webinar. And there's a lot to digest, and we do have this in a recording. We'll make it available. And thanks again, Mark. This has been very informative. Really appreciate it.
Okay, Colin, thank you. And thanks to everybody who participated. Look forward to more of these sessions going forward.
Definitely. Thanks again, Mark.